Good morning, you're watching Daybreak. This is Bloomberg Quint Live and I'm Alex Matthew. First, the headlines this morning. Asian stocks are off to a weak start. The yen trades stronger while the 10-year Treasury yield remains above the 3.2% mark. The International Monetary Fund has retained India's growth forecast for FY19, that's the current fiscal, at 7.3%. The forecast for FY20, that's the next financial year, has been cut to 7.4% from 7.5% earlier. Goldman Sachs Tim Moe says he downgraded India from its outperform rating as the risk-reward in the market, in his opinion, was no longer favorable. Jaguar Land Rover will undertake a 2-week shutdown of its Solihull plant owing to weak demand for its vehicles. And there seems to be no respite for the Indian currency. The rupee ended Monday's trade below the 74 mark for the first time ever. Let's talk about the session in the US. The Nasdaq fell on Monday for the third straight session as a sell-off in Chinese markets sparked concerns about slowing global economic growth, though the S&P 500 pared losses to end nearly flat. Abigail Doolittle of Bloomberg News wraps all the action on Wall Street in this report.
Stocks finished mixed in Monday's Wall Street session, with both the S&P 500 and the Nasdaq falling, but the Dow did manage to eke out a small gain, up more than 0.1% after a real seesaw session. As for the S&P 500, down for a third day, down fractionally, but the tech-heavy Nasdaq really underperformed, down about 0.7% over the last 3 days, having its worst 3 days since the end of July. This as investors continue to worry about rising interest rates, even with the bond market closed on Monday, plus the trade war with China. Lots of the Nasdaq companies do have exposure to China. Not surprisingly then, tech, the worst sector for the S&P 500, about evenly divided between up sectors and down sectors, but the tech sector down more than 1%, down for a third day in a row, really dragged down by some of the big well-known names, including Apple, Microsoft, plus some of the payment processors, Visa, along with MasterCard. Salesforce.com, another big loser there for the tech sector. But on top, some of the defensive sectors. Not surprisingly, investors going towards some of those safer sectors, including consumer staples, along with the utilities and real estate sectors. As for the Nasdaq, one of the questions could be whether or not the weakness will continue. It has sliced below its 50-day moving average and 100-day moving average. Recently, the small cap Russell 2000 hit onto its 200-day moving average, so some investors may wonder whether that tech-heavy Nasdaq will follow suit as investors are taking some chips off the table. Tech is still the best sector on the year, high flying. At one point, the Nasdaq up about 20%. So this could just be a little bit of a cooling off. And as for the mixed finish, maybe some have hope that the bulls are really trying to take control. But when we go cross asset class, there is a little bit of a risk off tone. The VIX did spike higher, that quote unquote fear index. Plus the Japanese yen up for a third day in a row, the best 3 days since the middle of May, telling you that even with the S&P 500 about flat and the Dow up slightly higher, the Nasdaq lower, some investors going toward the safety of that currency pair, that Japanese yen. So overall, Monday's Wall Street session following suit to Thursday and Friday with a bit of a risk-off tone. In New York, Abigail Doolittle, Bloomberg News.
All right. Well, just to check on the Asian markets and how they're faring at the moment. Remember, it's a little too early to tell you how China is faring. It's just the first few minutes of trade in that market. But seemingly, the Nikkei in Japan, which had started with cuts of as much as 1.3% earlier in the session, has reclaimed some ground. It's still trading lower by over 1% at the moment. The Australian benchmark continues to trade weak, around that 0.9% lower. The two benchmarks that we track in China, in the China region, have opened the session with gains of about 0.3%. Remember, they were playing catch up yesterday and they lost significant ground after having been shut all of last week, so they were catching up with the rest of the Asian markets. The Hang Seng has also opened with gains of about 0.2%. But let's talk about India, and Darshan Mehta is here to tell you everything that you need to know ahead of trade today and all that's happened in the futures and options space. Darshan, well, You can't really say, and of course there are a lot of individual factors to look at with regard to India. The IMF forecast is one of them.
Yeah, so they've maintained the forecast 7.3% and 7.4%. But what I'm rather surprised, because when we were doing the podcast, the SGX Nifty was up almost 50 points. Now it's just up 7 points, and we were rather confused because globally US markets didn't do well. Europe actually saw a big sell-off that came in, and Asia is trading rather weak in trade. So again, our markets will continue to be under pressure. There is no silver lining, at least at this point of time. So look at the SGX Nifty. It was up 50 points around 15 minutes ago. Now it's up just 6 points. We ended up in trade yesterday, but let's take a look at the other factors. Let's see how the ADRs panned out in trade, and most of the ADRs were down in trade. Vedanta itself was down 10% in trade here, so that reflected on the US markets. Wipro, Infosys, Tata Motors also down in trade, and Tata Motors will probably react to the weak JLR numbers and the 2-week plant closure. The only thing that did well was private sector banks, HDFC Bank and ICICI Bank. Apart from it, there was selling pressure that came in all across. As far as our markets were concerned, yesterday, despite heavy selling on the mid-cap and the small-cap end of the market, the Nifty ended up 31 points, and it was only and only on account of Reliance moving up 6% that the Nifty was here. Otherwise, it would have been deep in the red. As far as the Bank Nifty and the Nifty PSU banking is concerned, they managed to inch up, given the fact you saw that ICICI, HDFC Bank, some of the other private sector banks like Kotak managed to do well in trade yesterday. If you're looking at the other parameters, which were the counters, which were the sectors which saw heavy selling, real estate as a back saw 3% sell-off, metals saw 3%, you saw Vedanta was down 10%, Hindalco was down another 7%, Nalco was down 8%. So there was heavy selling across metals, and commodities as a pack has not been doing well of late. So for the past 2-3 days, there has been selling. Now, if you're looking at it yesterday, again, FIs were sellers, DIs were buyers. So overall, what you're seeing is whatever the FIs are selling, slightly less than that is something that DIs are buying, but DI money liquidity is not enough for the Nifty to actually move up at this stage. Now look at the move. Out of the 31 points was the gain on the Nifty. 55 points was the contribution solely on account of Reliance. Kotak, Yes Bank, SBI contributed, but the move, if this wasn't for Reliance, we would have been in the negative yesterday. HDFC Bank were weak in trade. Vedanta was weak in trade. ITC was weak in trade. So we were up 30 points, but solely on account of Reliance. Now let's take a look at the Nifty futures and the Bank Nifty futures. The Nifty futures saw fresh buying on very, very low open interest build-up. So whether it can sustain or no is anyone's guess. Look at the Bank Nifty future, and that's a short covering that came in. And the Bank Nifty overall over the past few days has been performing slightly better than the Nifty itself. No stocks in the F&O band, but look at this. 10,000 is where the biggest support for the Nifty is. But even from levels of 10,000 to 10,500, put writers are rather aggressive in trade. They have written position. It's almost 40 lakh shares here. But call writers are not very aggressive. Below 10,400 and close to 10,500 is where they are taking positions. Yesterday, what we saw in the market, even though the market managed to move up, put writers shed positions in open interest, giving an indication that the market is still weak. They're writing in at levels of 10,000, and from 10,300 to 10,700, call writers are very, very aggressive. See, even though at 10,000 and 10,200 they're not being aggressive, gives an indication that they are expecting a pullback as far as the market is concerned. But at that time, probably they will again write in to give an indication. But overall, this trend certainly shows that the market is looking weak. There could be some bit of rallies, but overall the trend is on the downside. PCR moved up for the Nifty. The Nifty was up 30 points. The Bank Nifty PCR also moved up, but not substantially, at 0.79. Now, if you're looking at the four stocks I want to talk about, Chennai Petros yesterday saw fresh shorts. It was down 10% on open interest build up of 20%, so extremely weak set of cues coming in. Voltas again saw fresh shorts, open interest build up of 16%, that too on the short side. The other two counters is Tata Elxsi. Came out with numbers, even though the numbers were not bad, they were in line to slightly coming down below estimates, but 10% the counter was hammered down on open interest build up of 10%. And the final counter I want to speak about is Kotak Mahindra Bank. So short covering that came in yesterday. Open interest was down 8%, the counter moved up 5%. Whether this rally will continue, difficult to say with the weakness in the overall market.
Thanks so much for that, Darshan. Well, let's talk about the update that we've just received. In fact, the International Monetary Fund meeting that's happening in Bali, they've retained their India growth forecast for the current financial year and marginally pared their forecast for the next financial year, citing the drag from higher crude oil prices and the tightening of the global financial situation. But India will remain the fastest growing major economy, well ahead of China. In its latest World Economic Outlook, the IMF has said that India will grow 7.3% in the current financial year and 7.4% in the next year. In January, it had forecasted that FY20, that's the next financial year growth, would come in at 7.5%. China is forecast to grow at 6.6% and 6.2% in 2018 and 19 respectively. Remember, that's the calendar year, not the financial year. IMF in its press release said the acceleration reflects a rebound from transitory shocks with strengthening investment and robust private consumption. The forecast for investment growth in FY19 is weaker than it was in April, or that it was projected in April, despite higher capital spending. Let's also listen in to what Maurice Obstfeld, the chief economist at the IMF, had to say about his view on emerging markets.
Last April, at the time of our last World Economic Outlook, the world economy's broad-based momentum led us to project a 3.9% growth rate for both this year and next. Considering developments since then, however, that number now appears over-optimistic. Rather than rising, growth has plateaued at 3.7%. And there are clouds on the horizon. Growth has proven to be less balanced than we had hoped. Not only have some downside risks that the last WEO identified been realized, the likelihood of further negative shocks to our growth forecast has risen. In several key economies, moreover, growth is being supported by policies that seem unsustainable over the longer term. Growth in the United States, buoyed by a pro-cyclical fiscal package, continues at a robust pace and is driving U.S. interest rates higher. But U.S. growth will decline once parts of its fiscal stimulus go into reverse. Notwithstanding the present demand momentum in the U.S., we have downgraded its 2019 growth forecast owing to the recently enacted tariffs on a wide range of imports from China and China's retaliation. China's expected 2019 growth is also marked down. Domestic Chinese policies are likely to prevent an even larger growth decline than the one we project, but at the cost of prolonging internal financial imbalances. Overall, compared with 6 months ago, projected 2018-2019 growth in advanced economies is 0.1 percentage point lower, including downgrades for the Euro area, the United Kingdom, and Korea. The negative revisions for emerging market and developing economies are more severe, at minus 0.2 and minus 0.4 percentage point respectively for this year and next year.
All right, we'll bring you more details as they emerge from that conference that the IMF is holding at Bali. But let's move on now and talk about an update that's coming in from Goldman Sachs. Tim Moe of Goldman Sachs says that the risk reward in markets like India is no longer favorable. Moe cited the outperformance of the last 3 years in elevated valuations as the key reasons why Goldman Sachs downgraded India to market weight. In an interview with Bloomberg Asia, Moe said that he expects the Fed to hike interest rates 4 times in 2019, while the markets are discounting only 2. Listen in.
We think the market's actually discounting pretty significantly a hike in the fourth quarter, so that's probably not too much of a surprise. What is going to be more challenging is our more hawkish view of Fed policy in 2019. Our U.S. economists continue to look for 4 hikes next year. The market's discounting 1 or 2, and so there's a gap between what we think will take place versus what the market's discounting, and I think that'll be more of a challenge as we go into 2019. Additionally, as you've said, we are likely to see evidence, really for the first time since the global financial crisis ended, that the combined balance sheet of the G3 central banks, the Fed, the ECB, and the Bank of Japan, those balance sheets are likely to turn slightly negative into Q2 and Q3 next year. And so, as you said, the tide is gradually turning from QE to QT, or quantitative tightening, and I think that'll be another headwind for markets as we go into 2019. So our composite view is that equity returns from here are likely to be much more subdued going forward into 2019 and probably beyond, but that in the fourth quarter we could see somewhat of a tactical bounce for the reasons I was mentioning.
If you look at Asia, Tim, can you pick out for us some of the emerging markets in this part of the world that might be more buffered when it comes to trade? And, putting aside, obviously, the dollar is always a key component of how emerging markets go, ones that don't have the idiosyncratic problems that would cause, massive fundamental issues?
Well, Heidi, it's a great question. Let me just answer that in a couple of parts. First of all, just to put our views on the table, we also think that both the performance spread and the valuation spread between the U.S. and emerging markets is quite stretched. Just parenthetically, if you look at sort of a rolling chart of 6-month relative performance between the U.S. and EM or between Asia, that rubber band is really stretched quite wide right now. So we think some sort of a bounce back in relative performance is due. So that'd be the first point I'd make. Second, obviously, the reason why things have gotten this stretch is because of many of the challenges that we've been speaking about in this and the previous segment. In particular, I think the heightened concern over the trade conflict between the U.S. and China. And that leads to the third point, which is that unfortunately the parts of Asia which look the most interesting from a valuation standpoint are the ones that are in the crosshairs of these various concerns, aka China. I mean, China, particularly after the sell down that we've seen in the past 5 days, is trading in round numbers, both the offshore stocks as well as the onshore stocks. We're trading at about 10 times forward earnings. Our measures of risk appetite are sold down quite significantly. And if we're right about earnings roughly holding in, as I mentioned the numbers before, sort of at the low teens, then that suggests that we have a pretty interesting risk-reward environment for China. Now, obviously, it's hard to convince people to go back into that market right now, given all the uncertainty over trade. So that's one of the reasons why we changed our view on Singapore to overweight. We think that Singapore is relatively less exposed to the concerns over trade. The market has performed weakly, and on a valuation standpoint, it's one of the cheaper ones in Asia. And additionally, if you look at the key industries, there are a number of industries like banks, property, and offshore industrials that are beneficiaries of the rising interest rate environment and also the increase in oil prices. So we think on a relative basis that the prospects for Singapore here look more encouraging. And as I said, it's less exposed to concerns about the dollar and about trade. So that would be sort of where our views are. If I could just add one thing, we did lower our view on India about 3 weeks back from a long-standing overweight, where we've been overweight for about 5 years, down to market weight. Now, to your question, India is one of the least affected directly by trade, but the market had outperformed very significantly and was trading at very elevated valuations, and for a few other reasons that are specific to India in terms of some slowing in the short-term macro data as well as the political cycle there, we felt that the risk-reward was no longer that attractive, and we took our view down.
All right, that's a word coming in from Goldman Sachs. Let's move on, though, and talk about one of the big talking points, in fact, in recent times. The rupee has extended its weakness against the dollar to a fifth consecutive session, declining 30 paise to close at a record low of 74.06 against the greenback on Monday. And while there are several factors that have put pressure on the currency in the recent past, the heavy capital outflows that we mentioned at the start of this program have caused concern. Dollar demand globally strengthened after China's central bank eased its domestic policy to support the economy amid a deepening trade war with the US. And that has increased pressure on growth in the world's second largest economy. In other currencies that have to watch, the euro and the pound rose after the European Union's top negotiator said an agreement for Britain to leave the economic bloc might be reached in the coming weeks. Speaking about what you have to look for today, there seems to be more weakness in store for the Indian rupee. It is trading at levels of 74.39 in the non-deliverable forwards market, indicating a weak start for that currency. Let's shift focus now and speak about commodities. Jayesh Khilnani is joining in with the details there. Jayesh, good morning. What do you have for us?
Morning, Alex. Let's start off with oil prices, which have seen a steady decline to touch a one-week low. Now, what the market is actually, expecting that the Iranian supply disruptions may not be as severe as expected. And on the other hand, the U.S. crude oil inventory also indicates an increase of about 2.5 million barrels for last week. Now, remember, this is as per a Bloomberg survey. But shifting our focus to the base metal space, we've seen some bit of weakness come about in the last 3 days as the index ended lower. all base metals except for copper declined in trade. Aluminium was the most impacted metal over here because Norsk Hydro says that the major alumina plant in Brazil is now ready to open. So on account of that, we saw some bit of weakness come about for aluminium prices, which lost about 3% and that was the biggest drop since April this year. On the other hand, we had some of the other base metals like zinc, nickel, lead and tin, which also posted losses on the London Metal Exchange. However, if you look at the initial trades that are coming in from the Shanghai Futures Exchange, we're seeing some bit of green over there with all the base metals trading with a slight bit of positive bias. It was a bad day for gold as well, which declined more than 1% on the back of a stronger dollar and rising US bond yields.
All right, thanks so much for that, Jayesh. Now, Google is shutting down its long-shunned Plus social network for consumers following its disclosure of a flaw discovered in March that could have exposed some personal information of up to 500,000 people. Bloomberg's Gerrit de Vink reports.
Google decided in January of this year, so just the beginning of the year, to do a very extensive security and privacy review. They looked at all their APIs, so those are the things that allow developers to request access to your information when you get one of those notifications that says, can app X, look at your contact information. They reviewed all of those across their platform, and they found what they call a software bug, where developers could see some of the information about people, such as your name, contact information, address. None of the private messages that you would have been sending on Google Plus, if you were sending any of those, would have been exposed. But still, it's some serious personal information that was out there. They decided at that point, right when they found it, they fixed the bug, but they didn't talk about it. And the reason from their point of view is that they found no evidence that it had actually gotten out, that anyone had actually used this insecurity to steal data. And so they decided, in the context of Facebook sort of taking the slashing, it was right around the time where Mark Zuckerberg was preparing to go up to Congress to face his accusers there. They decided to just not talk about this. And the Wall Street Journal, which originally reported this story, cites their sources that say Google specifically made this decision because of the political scenario they were in.
All right, well, let's talk about the stocks that you have to watch out for and trade today. Shraddha Babla is joining us with all of the stocks in the news. Good morning, Shraddha. What's on your list today?
So, Alex, at the top of the list is Tata Motors, and this is on the back of JLR's global sales numbers for the month of September, which are down 12.3% on a YOY basis, mainly led by weak demand in China. Additionally, there is a Bloomberg report which says that JLR plans a 2-week shutdown of its UK plant at the end of October to cope with the weakening global demand for its luxury vehicles, negative development for that counter. You also have Sadbhav Infra Project, whose ARM has won an arbitration award against the NHAI for 110 crores, so positive development there. GM Financial will be in focus as well, and this is on the back of an ET report which says that GM Financial ARC is in advanced talks to sell the debt of Hotel Leela Ventures to Brookfield, and that it is keen to retain about 10% stake in the chain post the transaction. So watch out for that name. Reliance Capital and Reliance Home Finance will be in focus as well after Care Ratings has downgraded the rating on these companies by 1 notch to Care AA. You have NCL Industries, which is a cement company which has updated its September quarter numbers. The cement dispatches for the quarter are up 31% and the cement board dispatches are up 7%. So those are some of the stocks to watch.
Well, thanks so much for that, Shraddha. Sumit Sarkar is standing by with the big brokerage calls of the day, and some of our viewers have been actually waiting for this, Sumit. What do you have for them today?
Good morning, Alex. On the big brokerage calls for the day, first we have is JP Morgan on Tech Mahindra. Now, the brokerage has raised the rating on the stock to overweight from neutral and has also hiked the target price to 925 from 835. Now, according to the brokerage, Tech Mahindra is nicely putting in place the building blocks to win the 5G contracts going forward. Now, the brokerage is expecting the 5G spending to pick up in 2019, with Tech Mahindra getting its share of contracts for this network upgradation plan by 2020. Now, a reasonably good 5G deployment, even with a couple of large carriers arrears should suffice a robust growth for Tech Mahindra going forward, says the brokerage. Lastly, Tech Mahindra would re-rate as its strength is visible in tapping this 5G revenue stream in the next 6 to 12 months' time, says the brokerage. Second, we have is JP Morgan on Larsen & Toubro. Now, the brokerage has maintained its overweight rating on the stock, but has cut down the target price marginally to 1,570 from 1,600. Now, according to the brokerage, the company is on track to meet its FY19 inflow and revenue growth guidance. And it is also expecting the company's consolidated return on equity to rise by around 300 basis points to 17% by financial year 2020. Now, for the second quarter, the brokerage is expecting a 50% growth in the order inflow for the company, while it is expecting the service business to drive the P&L growth for Larsen & Toubro in the second quarter of financial year 2019. Now, on the back of these two reasons, the brokerage is also recommending investors to buy the stock ahead of the second quarter results.
All right, thanks so much for that, Somit. Well, there you have it, Karan Kothari, the big brokerage calls of the day, especially for you. That's all we have for you, though, and I'm talking to all of you. That's a wrap on this edition of Daybreak. All you need to know is up next. Do stay tuned. This is Bloomberg Quint.